Welcome to Grid. Tonight we are talking about an introduction to commercial, multiplying your income with the multi-unit, multi-tenant, multiple use for properties. And we've got an incredible guest tonight. Erin Thomas is joining us. I'll bring her up here in a second, give her a full intro when we do, from Grid Cleveland. I'm very excited y'all here tonight. Who currently invests in or is involved in commercial real estate? Awesome. And who's here because they want to get into it? And who's here because they just love us? Awesome.
All right,
fantastic.
cool. We love them.
We got the whole room represented. Cory, what's Grid?
Yeah. So Grid is a national investor network that crosses the entire United States. We like to bring these together through hyper-local meetups just like this, where you can get investors in the community to all come and learn together. So we oftentimes like to say, like, we're not here to be like gurus to tell you all like the high fives and the wins. We're just real people doing real deals in real time, sharing our experiences with you, trusting you're going to share your experience with everybody here in the room so we all get to learn and grow together.
We've got Denver just launched, Grid Birmingham just launched as well. There's a couple more that are coming. And then Chicago keeps popping up, satellite locations. Kenosha, Wisconsin's launching. We have one in Madison already. There's one in Northwest Indiana. They're growing like crazy. So why do you do this, Cory?
I do this because I have always been a fan of real estate investing. I like working with my friends. So crazy thing. We used to throw a party and I get to work with my friends all the time. Right. Yeah. We do this certainly like as part of my business as a real estate agent, as a team leader. This is a two-part thing. This is our cash machine and wealth machine we like to create. Like my agent business is the cash machine. We all have to have a job, something that creates consistent income. And then what do we go do with that income? Where do we go invest that? That becomes like our wealth machine. So why I do this is I get to build both at the same time.
Yeah, I'm a big believer in networking. Like my whole life has changed from going to networking meetings and meeting the right people and meeting the people on stage and then putting together my own conferences and just learning that I think this is actually a lot easier than we think it is if we're listening to the right people. And if we have the right people and if we have a team. I was talking to a builder today and he was, we're doing new construction next month. And he's like, someone already asked me about how to become their own GC. And he's like, you can do that. I would not recommend that, for that person. This is like a part-time job. They need to hire a GC, but just having the right team makes all the difference. We've seen that. If you're brand new here, just not to undersell what Grid is national. We've been running this for 17 years. Our partner, Rob Chavez, started this in Northern Virginia. He's been running an investor meetup for 17 years. We just had our national conference. It's the first one we've done since COVID, right? And there's people in that room that have been going there for 15 years. I just interviewed one of them. We do a podcast every week. And Jan started off going to a fix and flip workshop. We'll run one of these in the fall. And then 15 years later, he's raising $100 million for land development. Like just sitting in the room, being in the right room, going on the journey. So the goal of Grid was, what if we had like no offense to another, like a real estate investing meetup where we didn't charge any money. We gave you all the information. We gave it away for free. The reason we run this is we want to do deals with you. If you are brand new, we want you to learn. Do not jump in, like learn, ask questions, like we'll pour into you. And then when you're ready, we want to go do transactions with you. Glad Adam is here. Like Adam wants to get into investing. Hey, we want to go on the journey with you, connect you with people, be a resource for you because we're doing the same exact thing. We want to invest in real estate. So we found, hey, if I run a real estate community and I build a community that I want to be a part of, like that's all I have to do is pour into this community and everything's come back out of it. And I see people in the room that I've seen build some pretty big businesses, vendors, et cetera, from being in the room today. So talk to everyone. Everyone in the room is a great resource. If you're brand new, come and stay. If you invited some people tonight, George, thank you. Joey, thank you. Some of the people, Jay, thank you for bringing some people tonight. We're glad that you're here. Cory, you want to get started, dude?
Totally.
Would this be easier for anyone if we actually, I've been working on this and it is such a pain to send out a text message, the hoops that I have to jump through, like to be in compliance with canned spam. And would anyone actually want to get like automatic text reminders so you don't forget about Grid? Like, is that a useful thing for us to solve? I know people have signed up. Yes. All right. Now I'll figure out a way to do it. I think I can just do it through my CRM. That'll come from, but I've been trying to do it like Pizza Hut would do it or something like, and it's been It's been a mess getting it approved. Yeah.
It's been a journey.
Okay, cool. What do we have going on this month before we jump into this?
Yeah, cool. So for us, it's our kind of a normal lineup. We get to have our grid meet up here tonight.
Yep.
We'll lead us off here. After that, it's going to be Investing 101, hosted by Travis Dupree. That's held here now. So new location that is here on the second Saturday of each month. That's going to be August 15th. And then wrapping up here with coffees, donuts, and deals on Friday. That's our Friday morning coffee meetup that we do at U-Brew in Bearden. If you can't articulate, hey, this is my buy box, right? I do outdoor industrial storage. I buy duplexes, in Northwest Knoxville. If you can't kind of clearly articulate what your wealth machine is that you're building or the cash machine you're articulating, please come to that Investing 101. Don't be scared off because it says 101. We're going to have a conversation with you. We've built this all out, rewrote the entire thing. There's some homework you can do before you go there. We're going to talk about what's your burn rate every single month? What's the freedom number you have to reach? It's very similar to some of the one-on-ones we've had with some different people in the room here, right? What's your access to capital? Are you adequately insured? What does your asset protection look like? If we've done all that, then we can have a real conversation on what a buy box looks like. So I highly recommend you come and check that out. This is like a mini version of what we do when we coach people on a national level. Grid. Erin's a coach. Vernon is one of our grid coaches in the room here. I think it's the most valuable thing we can do. And I highly recommend showing up, even if you've done this before. I think it's the best thing we do. And we got coffee, donuts, and deals. All right. Boom. Look at that guy. So Tuesdays, that's not right. 15 minutes. It is not 15 minutes. It is 45 minutes and it's always an hour. So just know that we go back and forth. They want it to be 45 minutes. I think it's always going to be an hour. We interview, top producers. So we just had a conversation with about building a cash machine next Tuesday with Matt Magel. Next Tuesday, we're going to be talking about cost segregation. Anybody done a cost seg? Anybody heard of cost segs? You have no idea what a cost segregation is? Awesome. So if people talk about the tax advantages of real estate, cost segregation is one of the ways you unlock those tax advantages. You own investment property, you can accelerate the depreciation on that asset, which can be really advantageous, right? We're in an inflationary environment. So taking those losses now and paying them back later with inflated dollars can be really advantageous for you. Saved me $15,000 last year.
Yep. It works. It
was great.
My job is to scold Cory, is to poke Cory. Yeah. Hey man, we should do this.
Yeah. Do this.
You should go do this play. Because Cory's always quicker to take action than me. So it's, and he did it. It worked out really well. So see, it can be a big savings for you. We have a guy that runs CSSI. One of the best sessions I've been in as a grid leader. So you can plug in with that. And then we've got your partner, Wayne Brooks, another grid coach joining us at the end of the month to talk about flipping as a cash machine. Wayne's flipped 1,000 houses. So if you're kind of curious of tapping into the Grid National Network, totally free, gridtacticaltuesdays.com. Check that out. All right, let's get started, Cory. And thanks to our sponsors. I don't know if we have any of our sponsors in the room today other than Dalton.
Dan had a church event.
Dalton, hello. Who are you? You should really be on camera. Anyways, Dalton, if you've ever seen any of our media, Dalton does all of our media for Grid Knoxville and Grid Smokies. We also, because we'll talk about Grid Smokies here at the end, I think, Brian. We'll let you do a plug for what we have going on there. But if you're interested in short-term rentals, we have another short-term rental focused grid community. All right. Erin, do you want to join us? You want to come on down?
Yeah.
Let's see. Erin Thomas, come on down.
Where do you want me?
Right in the middle.
I like it.
Right in the middle. Get a close up of her holding the mic with her new nails.
But I forgot my shoes to
Listen,
get the
you
nails
didn't have
done.
to, no one was going to notice. I was drawing attention up. Work with me. Erin is joining us. Erin runs our Grid Cleveland, and Erin, I truly think, is one of the best commercial agents that I've met in our industry. Erin, how long did I chase you to become a grid leader? We had this conversation. It was started 2 years ago.
It was, is this thing on?
Yeah. Just got to talk right into it.
Okay. All the way in. Okay. So probably about 2 years, you chased me to do it. I had just come out of leading and launching another networking event with a group of people. And there were 6 of us. And originally I said we were like the Spice Girls. We each had like our own lane. And so it worked really well. And then it didn't. And so I exited that and I just needed a break. And Grid is fantastic, but Grid was built on residential investing. And while I started doing, residential investments, I just wasn't doing that. So it didn't speak my language. But Grid and Rob are so amazing. We had a conversation and literally Rob went, okay, and built out 6 months worth of curriculum related to commercial real estate. And then I couldn't say no.
And so we just created that the same way we created some curriculum for the short-term rentals. Erin comes from the market in Cleveland. What's really unique about Cleveland is, and you could probably give us more, there seems to be more. I love it. He's repping the city.
There we go.
He's got the Guardians on. That's awesome, dude.
They're the Indians.
Well, that's not an Indians jersey. That's a Guardians jersey.
It's tough to call them something different.
I hear you. We got some Commanders fans in our world. Well, at least the Guardians make some sense. Commanders is fascinating. But Erin, when I went to Grid Cleveland to launch Grid Cleveland, what I was struck by is like I had never been in a room that had that many people that own that many doors. Because multifamily is just so prevalent in Cleveland, and the access to the market is so prevalent. So I want to bring Erin here because Erin, like, how many doors do you think have you seen now in the last few years in commercial in your career? Like, you've been involved with going on thousands of doors at this point.
Yeah, I wouldn't even know how many doors I've sold at this point. And Cleveland's entry point is really low as well. So if it's not multifamily, they're in single families, but you can buy a single family for $50,000 all day.
Yeah.
And that $50,000 property can cash flow you $1,000 a month with a tenant already in it. It's not the best neighborhood, but the cash flow is strong.
Should we take a seat?
Yeah.
All right. Let's sit down and talk about this. So, and then on the multi side, I was struck. I was sitting there. We'd launched Grid Cleveland. Someone was introducing themselves, and then he said, "Hey, in this city, I buy at $30,000 a door. In this city, I buy at $40,000 a door." And I was like, okay, this is insane. People need to know when we have the conversation about investing and we talk about the balance between appreciation and cash flow. Like, there are some markets where you can really cash flow. When you ask people, do you want both? It's like, no, there really is a division of, like, when you don't have runaway appreciation, then you have low prices for years where things still cash flow. So I wanted to bring Erin here. If you have questions, she just has been my go-to because she just had done more multifamily transactions than anyone that I knew, was an instructor with KW Commercial, right? On a national level. And I think, that seems to be the logical entry point. I always feel like investing is the gateway drug to commercial. Yep. Like you're already doing commercial, you just don't know it.
Yeah, I think
in some ways, like you're not doing all of it, financing, insurance, but you're doing a lot of the other things.
Exactly. Like how I became a commercial agent was I was just working with investors and I was investor only. And eventually those investor only went from, 3 units to 4 units to 6 units. And I recognized that there was nobody else who understood how to underwrite a property. Nobody wanted to specialize in investment properties, but we're such a strong investment market. I was like, somebody should do this. I honestly built my entire name and my brand on learning how to underwrite deals. And then people knew me for underwriting the deals. So they came to me as new investors because they knew I could underwrite the deals. And then everything kind of just escalated from there. And then I was working with more experienced investors because they knew I would underwrite it and it was a safe bet.
So let's start with that. Like, how do we underwrite? What's maybe different about underwriting a commercial or multi-unit property than just doing a single family?
Well, everything.
There we go.
So, the number one thing is, the way you value the property is totally different to start with. Is you're going to look at comparables of other properties that have sold when you're buying let's say 1 to 4 unit, right? When you jump that 4 unit, and 4 units are going to experience this, but when you jump that 4 unit, everything goes to income. And so the entire value of the property is based on the income that building is producing. And then that escalates. In multifamily, it stays the income and, you have to know the cap rates and such. But then when you get into retail, it's the income it's producing coupled with the type of tenants and the lease lengths of the tenants, right? And so everything just kind of keeps building itself up from there.
Does everyone understand why that is? Does anyone not know why it changes? It's financing, right? So financing of a single family property is going to be based on usually a sales comparable approach, right? Because the majority of people that are buying single families are using a bank loan. So they're using a sales comparable approach. If it is an income producing property, you'll see this sometimes on short-term rentals, they're going off of the income for the valuation.
Well, It's that, but it's also that coupled with the fact that I can own a 10 unit and you can own the 10 unit next door. And I'm charging my tenants $800 a month. Yep. And you're charging your tenants $1,200 a month. Are our buildings the same value? No. So it doesn't matter that they're both 10 units next door to each other. So same area, same size, same room, everything else can be exactly the same. And you would use that as a comparable in residential. We're not even close.
Yeah, you would have to. You would say, oh, wow, this one's selling for cheaper. Mm-hmm. It affects the value of my home, but it's not the case there when it comes to, so it's all based off of income, which is why we're investing, right? It's just how do I buy an asset? How do I either create positive cash flow or appreciation, have someone pay down the mortgage over time? Same fundamental principles, but everything is different because once you get above 4 units, you can't get residential financing. You get residential financing up to 4 units. Beyond that, we're into commercial. So I think looking at multifamily is a great way to wrap our heads around getting into office space or some of these other things. We can start with multifamily.
Yeah. It also, once you go into the underwriting, it's the entire property as a whole, right? When you have a single family property, your tenant pays you rent, you know what your mortgage is, you take that out, the rest you call your profit, right? We know we probably have maintenance and stuff we're doing out of it, but in general, it's kind of what it looks like. When you get into multifamily, you've got your income and you've got your debt, but your expenses, your insurance and your water and your sewer and who's paying that and who's not paying that. So what is the actual NOI? All of that plays a role now in underwriting the property, where in residential, it doesn't have as much of a stronghold, but in commercial, like you have to know those numbers and you have to be systematic. You have to be detailed in your documentation, like get a good management software. It doesn't have to be expensive, but you have to pay attention to those things or you're going to lose money real fast in the maintenance costs and, the other things that arise.
Where do we want to start? Because we could go a lot of ways with this. We could start with some questions.
Yeah, let's start with a question. Who wants to know what?
Yeah, who's got a question about commercial real estate? Dalton, appreciate that. RJ, you're dressed for it. Come be our mic runner. The most dapper agent in town. Our man RJ Duncan. Appreciate you. Yeah, who's got a question for us?
I have a quick one.
Okay, perfect. Cory does.
What's the easiest thing like most people miss when they're underwriting a property? It's like the most overlooked.
The taxes are going to increase and your insurance is going to increase. So when you get a P&L or the documentation from the owner, just know it's all wrong, right? If I'm selling you a property, I want to sell you the best numbers I can. I'm a little different when I list. I list for the buyer, so I'm underwriting it knowing what they're going to expect because it saves me a lot of headache down the line when they're like, well, when we ran our numbers. So what they don't take into consideration is if you bought the property and you added value to it, now you're selling it, 3-5 years later, the price he bought it for and the price I'm buying it for are totally different. So the taxes are going to increase immediately after sale. You can get creative and do things like, an LLC transfer, or drop and swap, whatever. But in the end, your taxes are going to increase. And most of the time, they're not taking that piece into consideration. And that is night and day. I did a deal. I actually bought the deal. The taxes were originally like $3,500 on its 17 unit. And it was like $3,500. The taxes ended up going up. I don't even remember that number. They probably went up to like $10,000, but the insurance was around that same number and went to $17,000. Because it was an older building. It was a non-traditional. It was almost like a Victorian house that had a 3-story commercial building smooshed into the front of it. And it wasn't what they wanted to insure. And the insurance market right now is tough, that if you're not taking those two pieces in, the deal's probably going to fail. Well,
because the sale is going to trigger a new assessment, right, from the local municipality. And it's going to trigger a whole new underwriting round with a new insurance company.
And another big note, you saying that is totally different, is you're going into a 5 or 10 year term loan. You're not going into a 30. And so the expectation of you having to refinance that in a short period of time is strong and it's very, very real. So if you're not creating that equity, if you're not managing the building appropriately, that refi is going to come, whether you like it or not. And either you're going to refi it or you're going to sell it because you can't get that equity out.
Nathan, do you want to talk about what we were talking about? You're texting me about these commercial deals, financing going. So, well, anyways, here's what we've seen is if you just saw this with Brandon Turner, right? From Bigger Pockets, he gave if you haven't followed him, Go follow him. Bigger Pockets, one of the biggest investing forums, the biggest in the country. He had a very honest post about losing a lot of money for his clients because he had commercial financing on a project and was unable to refinance out of it, right? The interest rate market hasn't been favorable. He got hosed. And we're seeing this happen again, where people are using this short-term financing, right? That is kind of the boom cycle that we did see, which is like, you can't lose money. Everything is going up. So if I'm making all this money flipping, maybe I should scale, I should syndicate, right? Fractional ownership, Grant Cardone, and we're seeing people get burned because of this financing. Like, if you cannot refinance, you are screwed.
Yep, exactly.
Yeah. Anyway, can be brave and ask some questions? I can go through a presentation. We got Tyler back there too. Go, Trav.
For like a multi-unit retail storefront, is there like a particular client that is better than others? Like a dental office?
Like as a tenant to put in?
Correct.
That's probably going to be market dependent. But here's what I'll tell you is, if you wanted to buy a shopping center and you're looking at it, part of what you should be analyzing about that property is, how do the tenants fit together? And if you're placing a tenant, for the realtors in here, that matters. And honestly, how the tenants work together matters more sometimes than the actual rent. And if you probably have seen shopping centers that sit with this one unit vacant for a long time, a lot of times that's not because they don't have interest. It's because they haven't found the tenant who matches the clientele. What do I mean by that? If you have a hair salon, and then you have somebody who wants to come put a convenience store in, or a snack shop or something, that's probably a coffee shop, a Starbucks. Those are going to work great together because, ladies, how long do we sit at the hair salon? We're stuck there for hours. We get hungry, want snacks. Those two things work together. But if you were to mix something else in and, let's say, I don't know, put a smoke shop, women might not come to that location because of the other tenants that's there, right? So they have to work together in order for, and that matters in the value. The other piece of that a lot of people don't know is that the base rent, when someone comes in, owners will protect that, because again, the income creates the value. They will protect that base rent, but they'll give you multiple months of free rent. They'll do your build out for you. There's a lot of creative things that they'll do in order to maintain that number, but still get you in the door and make it, a good concession for you. I'm countering an offer right now with 4 months of free rent because they're firm on their number. So we have to make it work.
That's fascinating.
So to answer your question, there's not a particular tenant. If I was in Cleveland right now, I would tell you I wouldn't place a smoke shop. And the reason for that is that we're about to pass a law, and I believe it actually just happened here, where CBD and Delta 8 are only to be sold in the dispensaries. Well, that's a huge part of their business. And so now they're a glorified convenience store, right? Do I want a glorified convenience store in my shopping center? There's probably going to cause a lot of issues because there's so many now with smoke shops, and that's going to really impact their business. All of those are not going to be able to survive in Cleveland.
And I think we've talked about this separately. One of the differences when we get into multifamily is the impact of tenants on each other. So it's the same, on a commercial retail space, but it's the same in a multifamily building. Like, if I place a disastrous tenant in a 12-plex, it can affect everyone in the 12-plex.
I listed a 42 unit and one of the tenants shot the other tenant. So yeah, that's real fun during your listing, by the way. It was on the sidewalk though, so I didn't have to disclose it if you were wondering, but but it did happen. But you're 100% right. And a lot of people ask, like, well, can I do Section 8 and private pay? Well, you can, but do your top dollar private pay tenants want to live with the people who are on Section 8? And the answer is probably they're not going to renew that lease after that 1 year. And what's cool and exciting about commercial, especially in retail, is that you get a 3, 5, 10-year tenant that's responsible for all the maintenance in their unit. So people get scared with commercial and, let's say, mixed use, right? They get scared with that mixed use because it's unfamiliar. But
what is mixed use if I'm brand new to this?
It's a commercial property that has mixed uses in it. So what you'll traditionally see is like a retail on the bottom and residential up top, but it could be anything. It could be office here. And, I've got a building coming that's retail and office up top. So it's just anything that has that combination of uses. But people get scared. They're comfortable with that residential, but they're nervous about the commercial. Well, commercial can take a little bit longer to fill that spot. But once that tenant's in there, it's 3, 5, 10 times the length. They're also typically, depending on your lease, responsible for most of the maintenance. So they're not calling you and blowing up your phone and having you come change their light bulb because they don't know how to do that. They're responsible for those things. So your overall cost for that unit and your likelihood of having to redo that unit and do a unit turn every year is much, much lower. And so really the maintenance and the overall expectations of that is lower. It's just you might have a longer holding period where there might not be a tenant in there. That becomes the risk and why people get nervous.
I love it. There's a question back there Tyler had.
Hey, so I'm newer to commercial, so I'm a little bit slow maybe. Why are we refinancing?
Because the term is only going to be about 5 to 10 years long. So you don't really have a choice.
So you're refinancing to get a better rate or to cash out?
I'm sorry. So the entire length, when you buy a residential property, you have the option to do a 15-year term, a 30-year term. In commercial, and lenders speak up if I'm wrong, but it's basically up to 10 years is going to be the entire term. And at the end of that 10 years, you have a balloon payment due. And if you can't make that balloon payment through a refi, your only option is to sell. And right now, what we see is they keep talking about all the trillions of dollars that are probably going to come to the market. It's because all these properties went out at these interest rates and the people, these loans are coming due and they're not going to be able to refinance out of them. So they're going to have to sell them. And what that might result in is short sales or, getting things at a better rate.
Just to follow up, what's the, how long do they amortize those over? And we got a banker in here. I don't know if you could, Jeremy, is it 30 years, 40 years? 15 to 25. Do we understand? So like you're repaying it as if it's over a 25-year period. Like they stretch out the payments that way, but a balloon payment is due where you have to make up the balance in 5, 7, 10 years. All right. Yep, exactly. So they amortize it over a longer period.
So I'm not correcting you, but I will say the unspoken thing that no one talks about is HUD and USDA do finance these. And those are 30, 35-year fixed for commercial, for multifamily.
Yeah, but then you got HUD. They just
take 9 to 12 months to underwrite. What?
Yep. You also have SBA financing.
Yeah, there's a lot of fixed options. Which can be
fixed. But
SBA and multi is going to get a little tricky, but
sure, it's more not a multi-unit, but like you can do SBA like on a commercial property. But the challenge is I have an offer out right now on one of these, and like trying to get them to accept the timeline, like the contingencies. Here's what we're running into is we really need like 145 days to have this thing approved. They don't want to take it off the market that whole time, so I'm going to have to put up non-refundable earnest money as a buyer, right? To tie up because they're incurring real costs while this is taken off. So this is a very different environment than just dealing with residential. Like if I'm asking for that much time, I'm going to have to put up some hard money typically. Yeah.
So I did have
hard money, meaning like it's non-refundable. It's when the money goes hard, it becomes non-refundable. Go ahead, Nathan.
So has your market, there's a few states that do about 50% in grants for commercial right now for multifamily to rehab. Have you guys gone to that yet in Ohio, or have you not seen that?
No, we have a lot of grants for specific areas. And when I say specific areas, I mean you should probably be a local investor who's comfortable with the risk of these areas. But
Gotcha.
They actually just released that they called it the brownfield grant. And last year it was a little shy. Everyone was a little upset because it's the lowest it had been. And this year it's going to be the highest it's ever been. We've got a whole area called the opportunity zone, where if you invest in the opportunity zone, there's a lot of tax benefits that you get from being in those areas. So there are grants. They're a little harder to get. I actually just saw Bobby George is a big investor. He owns a lot of the restaurants, some of the most known restaurants in downtown. He's in prison now because he's not a good person, but he's suing the city of Cleveland because he was promised a grant for a large redevelopment project that they were going to do. And when he got indicted for, strangulation and attempted murder, they took that grant away. And he's saying they were what's the right word? But they were basically going after him when it was an entire group of people that wasn't just him and the LLC. Exactly. So he's got a lot of money. He's trying to throw it around and prove a point here. We'll see what happens with it. What he was doing and creating in the development would be very good for Cleveland. It would create a lot of jobs. But he's also just not a person that you necessarily want to be in business with either. So we'll see what happens with that. But the grants are there. They're out there to be had. But they're tricky to get. They're typically in the lower income areas. Mm-hmm. Yeah.
So I think... Does anyone have any more questions? Because I think otherwise I'll kind of walk through a framework of maybe laying out some of I can't tell if there's a hand up or not, the commercial opportunities, or if he's just scratching his head. One of the reasons, and I think it says this on the slide right here, is we love residential real estate, right? Because people need a place to live. Like being a landlord makes sense. That's why multifamily is interesting. There's a lot of different asset classes on the commercial side. Businesses need a place to operate. Right. Industry needs a place to operate, warehouses, all this infrastructure, like someone has to own that. And it can be advantageous to own that. Let me walk through, like, if I wanted to get into multifamily, what's going to be different that I'm maybe not used to if I've only looked at 1 to 4 units?
So the overall underwriting that you're going to look at, the way you're going to evaluate, the leases, the financing, we kind of touched on a lot of those pieces. When you get into retail, like I said, it's going to matter what that tenant mix is. It's going to matter what the escalations are in that lease, how long those leases are. It's important to look at even
escalations, meaning like the rent increases, the CAM increases.
Exactly.
Okay.
So you're going to run into all of those things. And another big thing that a lot of people don't look at, whether it's multifamily, shopping centers, portfolios, is you need to look at the lease end dates. Because what happens is, like, the property, I'm listing a 32 unit. They came in, they renovated it, they placed a bunch of units. So there's going to be a 2-3 month period at the renewal when a bunch of these leases are going up. And that can cause a significant risk because they might have 8, 10, 15 units that are about to move out. So you either need to sweeten the pot, skip that increase you were thinking about, right? Or prepare for it. And if you have a shopping center that's going to do that, that is a very, very scary thing. And it would honestly deter me from buying that shopping center if all their leases were going to go up at around the same time. Yeah,
because you've got no one wants to go first, right? No one wants to be the only business in an empty, right?
Exactly.
An empty, abandoned shopping center. Yeah.
If you have a shopping center that has a big anchor, it's not uncommon for the other leases to have an escape clause that if that anchor leaves, they have the right to get out of their lease. And then what happens?
Jeremy, did you have something to share in that, or just got a mic? Mm-hmm. So, Jeremy, introduce yourself so they can have some context for who you are, what you do.
You can hear me?
Yep.
I'm Jeremy Cook, market president, Old National Bank, and lease agreements are vital. Great guy, really wanted to help him, but he had 80% of them rolling out in the next 2 years without anybody coming on board. So it's fine if they're going out, but you've already made plans and concessions for somebody to come in. We can go off that. Anchor tenants are huge because they'll bring other people like a Target, a Publix, or just somebody like that.
So anchor tenants, like a Target, a Publix,
somebody
big box
name, and everybody else can eat off of them on the side. And so we love those types of deals, but lease agreements, they matter, and the future of them matter.
And it's something people don't look at.
Yeah. No, thank you. And so when we're looking at these properties, what do you use so the other thing about looking for commercial properties that's interesting is they don't show up in the same ways. Like I can't just go, if I go look up a street address and I see a sign, I won't necessarily find the listing for that property, which is not accidental. Like you need to go through a commercial broker. It's like, it's not indexed by property. So I've got to go look in Crexy, our CoStar, our LoopNet. There's a high barrier to entry to get into commercial real estate on the agent side in terms of access to these platforms, paying for these platforms.
Who are the realtors? Do we have realtors in the room? Okay. So we typically go in, we create an MLS portal. It automatically sends them the listings, right? It's awesome. It doesn't exist in commercial. You can set it up in the MLS, but I always tell my clients, I'm going to set this up. If something comes up here, you're going to be the first to know about it. But realistically, most agents aren't taught how to do commercial. So the listings that go up there are normally priced incorrectly. They're under the wrong category so many different times. And so it's just not the place. But Crexy and LoopNet, cost money if you want to post there. And it's a lot of times too expensive for people, but you can get a free account to search these properties. But a lot of people don't have both. It's when you get into CoStar costs a lot of money. So most people don't have that. And so I made my brokerage pay for it. And so if you wanted to do commercial seriously, I would negotiate that in because it's a value to the entire brokerage. But so I have CoStar so I can look at that. But still, commercial agents, and I'm going to say this in the play, I love being part of KW Commercial because part of KW, there's a culture. We want to work together. We come from that residential agent mindset. There's a commercial agent mindset, which says I'm not going to work with residential agents. And it is a very, very true thing. If you're a residential agent and you've tried this, they don't want to work with you, mainly because it's different and they know they're going to have to hold your hand and guide you through it. And they don't want to do that. And so you run into that issue a lot. And so a lot of these agents, they also want both ends. So they won't even put them here. They only list them by themselves. So that 32 unit I told you that I'm about to list, that was listed with another broker who didn't really create an OM, who didn't have it on any of the platforms. So for me, it's like a brand new listing.
What's an OM?
An offering memorandum.
Yeah.
So I guess another good difference is that if you're listing a residential property, you put it up with a pretty photo and you call it a day. I'm taking all the financials and I use a tool called Intel CRE, which makes it amazingly easy for you to do this. But I upload the financials. I can upload the expenses. I can add the photos. I can add rent comps and sale comps. I can add everything into this one place. And then I can deliver it as a property website. I can deliver it as a brochure. I can create a flyer and they get all the information they need about this property. Because again, it's not just what it looks like, what the numbers are. I'm going to have to give them the T12, which is the profit and loss broken down month by month. I'm giving them the rent roll. I'm giving proof of tenant payments. I'm giving them copy of the utility bills for 12 months. They might ask for more. I'm finding the declaration pages from the insurance. I'm doing everything.
One of the things that is different in dealing with commercial versus residential, I've been a transaction coordinator. I've done both as the due diligence. You're doing a lot more work on the commercial side for the due diligence of getting you all the information that Erin just described. Like it is just fundamentally different. Again, we can all do real estate, buy real estate, sell real estate without agents. And I have found finding good, hyper competent agents, I'm looking for the best, is like one of my secrets for everything because they have all the relationships, they have all the knowledge, right? It makes everything significantly easier.
Because there's almost two parts to due diligence. There's the part that I ask, like say I represent a buyer. There's the part I ask the other agent for or the seller, which is all the documents I need, which are the things that I was just outlining. And there's a plethora more. And then there's the things that I have to do as the buyer, where I'm going in and, things like calling insurance companies and making sure that there hasn't been a claim on the property, calling the police department, making sure they're not constantly at this building, that you can do all these things. You want to know, verify like the utility bills, you'll call those things. It's more than just the walkthrough and the inspection, verifying the insurance, verifying, the tax increase.
What's the recourse if you're not given accurate information in a commercial transaction?
It's detrimental. First, if you're not getting the accurate information, it's going to be really hard to close the deal because a lender's probably going to spot that right away. And when there are times where you get the mom and pop owner. And
I've had mom and pop owners give us falsified rent rolls and they poached all the good tenants and moved them to other properties.
You have to safeguard, right? They're going to give you the rent roll and the rent roll is great. You're going to take that rent roll and you're always going to put it against the leases. And the two things have to match. And if they don't, you need to call that out. And a good example, there's a thing called an estoppel agreement. If you don't know what an estoppel agreement is, an estoppel agreement is basically the tenant signing a document that acknowledges that I have a security deposit of this amount and I pay this much in rent. And if there's a tenant there that doesn't have a lease, you want them to sign this document that says, I don't have a security deposit on file and I pay this much in rent. Otherwise, you'll close on them, but oh, no, I was only paying $300. I wasn't paying that full amount. That's wrong. That was fake. So you have to get these documents. Everything a seller gives you on a commercial property, find a way to fact check it yourself. Otherwise, you could end up in a really bad place. There have been people who buy a property and it was like, oh yeah, everything's $800 a month. They didn't verify with the tenants. They didn't verify with the leases. And none of those tenants wanted to pay that. That 32 unit, the property management company was claiming that they were charging, I think $50 a month for parking. While that's written in the lease, they weren't collecting it. And so here's me like, why are these numbers so different? Where is this money? And they're like, oh, well, they never collected it. So now the new management company is collecting $30. So the numbers look like they went down. They didn't go down. The management company just wasn't reporting accurately. And that's not even the seller's fault, right? That's the management company's fault. But I found that before listing because you have to do those things.
Nathan's question for those at home is, did the seller know about that information?
Yes and no. You know what I mean? Like, I think it was written on there and he probably thought, but wasn't paying close enough attention to the actual income that was remaining after it to recognize we were collecting rents, but we weren't collecting all these other things, you know?
So due diligence is a huge difference in multi-tenant, multi-unit, like separately. What are the other things? We got some here that talk about like when we're looking at due diligence, you know, permitting, transportation, like what are some of the other factors that, and I guess let's talk about, well, we could start with multifamily. Are there any other factors that you look at when you're looking at, let's say a 12 unit that might be different than a duplex? So parking, is it access to transportation?
Parking is obviously, it's going to create value, right? You can't increase your rents to top of the market if there's nowhere for the people to park. It doesn't make the deal bad. It just means you have to take that into consideration. Nearby transportation, if you're doing low income, I think knowing that there's a bus stop real close. There's also the Starbucks theory. Has anyone heard of the Starbucks theory?
No, what's the Starbucks theory?
Well, basically, Starbucks does so much market research before they place a location that if a Starbucks is there or is going into a location, it's a pretty safe bet that that's an area that you would want to invest in. And so when I list a property, I listed a property in Sandusky and there were 3 Starbucks within a 2-mile radius. That was in my OM. It was in everything I sent because it mattered, right? And so if you're trying to be in a higher end area, is it near a Starbucks? If you're in a lower end area, is there bike parking? Are there bike paths? Is there, bus stop and transit? Are they nearby a gas station? Because that's going to affect the tenants that can actually live in the building.
Yeah,
right?
100%.
And just like you sell a residential house, you're actually selling like what it feels like to live in that neighborhood. It's the same thing to the tenants. You're selling why they want to live in this neighborhood, right? And if there's not a reason for that, it's going to be harder for you to lease. And that's the same in, office space. That's the same in retail.
Yeah, Susie.
Okay, I have 2 questions now. The Starbucks theory, that's great. I thought you touched on that. Now, does that count the same if it's in a grocery store, the Starbucks is in a, because you see a lot of that.
It's popping up a lot. And I would probably say that it still does because, right, if we take this one right here, right, there's a Starbucks in this Myers across the street and it's a new Myers. It's going in. That Myers probably did research to put their location in there.
It's probably a safe bet either way.
Exactly. There's probably a connection between the two that they're still not going to invest the money to do that build out.
Not necessarily.
What's your second question?
And then the second question was when you listed the different commercial sites for things to go up on, I didn't see Moody's. Can you tell me how you feel about that? Is that one that you think is competitive against those or not?
So I don't use Moody's a lot.
Okay.
I don't look at, I haven't found much of a value there compared to the others.
Okay.
I would say in my market, I see a lot more activity recently on Crexy, where I think that used to be on LoopNet. I think Crexy became a lower entry option for a lot of people, so they're going there.
I agree, actually. I've seen more Crexy than LoopNet on stuff recently.
And when it comes to leads for my listing,
Mm-hmm.
it's 10 times different on Crexy. I get 10 times the leads from Crexy than I do from LoopNet.
And you feel like Moody's here is a little
actually,
bit irrelevant?
I'd love to ask Sakela if you want to pass her the mic. Like,
yeah.
right. So
that
Sakela's a local
this
commercial
does
agent.
matter.
Like, what do you see people using here locally? What are you guys using?
So what we use is all of it. We do that for a lot of different reasons, but what's part of our pitch when we list a property, we're not only, if we can put it in East Tennessee Realtors, we're going to do that. If we can put it in Crexy and LoopNet, we're always going to do that, and Moody's as well. What I've been finding recently is a lot of the downtown development areas are all on Crexy. They're not on Moody's. I like Moody's a lot because you can actually do like the same thing with East Tennessee Realtors on residential properties where it goes directly to your client, which I really like because it saves me a lot of time. So that's what I like. I'm not familiar with that. For me, if it's a residential property, you can. So, but commercial, I've been told you can't do it at all.
Yeah. Okay.
Huh.
I'm gonna.
It's also location dependent. For example,
with love, this is a very agent conversation, and I think let's have it over a beer afterwards. It's good. Thank you so much. Right. But like, we can pick because if you're not an agent, you're like my eyes are glazing over. But the reason we're going into this is like this matters, and when you're selling these properties, the thing that's interesting about commercial is if you list it correctly on something like CoStar, you can reach a national audience. So it's much easier to necessarily, you could get that California, Chicago, New York buyer to buy one of your assets, that you can reach a broader audience than just a local audience who might just want to be a passive investor.
And I will throw this out there. One of the perks of commercial real estate that I think is easier than in residential, and maybe it's because of the commission size for agents, is I've become an investor on many deals by putting my commission or a portion of it back into the deal. So it helps my clients decrease the amount of money they have to come to the table with. And I'm not coming to the table with really anything because I never actually received the money, right? So I put my money from my commission back into the deal and become a small investor on the deals.
What equity percentage do you usually go for?
So I think equity percentage when you're coming in is typically like if I was coming in as an LP outside of my commission ends up getting built in kind of by the amount that I'm putting in compared to, the total amount of, exactly, the total debt. So I've been a 50% investor and I've been like a 20% investor. So it really just depends on how much of the commission I'm putting into the deal.
Okay. Yeah, I dig it.
You need a mic to talk at Grid. We'll come to you.
It's a safe way to get into commercial real estate if you're new and,
That's what I was going to ask. Do you think you can be a full-time residential agent and do commercial?
Okay. So I guess the way that I would say this is residential, your specialty, your niche is residential. You might get some people who do luxury. You might get some people who do investments. In commercial, I think it's key to find your niche as an investor and as an agent. And the more niche you can get, the better off you are. When I did multifamily, and then I even got tighter with that. And I'm 30 to 90 units multifamily in Northeast Ohio around this region. I got very, very specific on what I was going to specialize in. And why is that important? If I was going to do industrial, now we're talking dock heights and location to highways and 3-phase power and oil separators and all of these other things that I understand because I've done it, but is it my specialty? Am I the absolute best person for industrial? Probably not. Am I the best person for multifamily? Left, right, center. Nobody's going to. And then I just started getting into the other multis because they were very similar. So then I started investing in shopping centers and, moving my.
How do you feel? So we talked about this. One of the titles we played with, and changed it on the site was the multis, right? Multi-unit, multi-tenant, multi-use. So how do you feel? What was the mental model in your head where you're like, this seems very similar to move from multi-family to multi-tenant shopping centers?
I mean, it's the same thing, right? I'm dealing with tenants on both sides of it. These ones have slightly different lease lengths, and there's a little higher risk with a vacancy where multifamily is very risk adverse. It's probably the safest thing you can invest in. If one tenant moves out, it's not going to make or break you the way an office or a retail or, something like that would be. In self-storage, that's basically like running a business, right? You're month to month, you're collecting those funds. It's totally different than a real actual investment property. You're not hands off. And so that's a different model. But for me, it's all the same. There's multiple units. They all have leases. It matters on the occupancy. It matters on the vacancy, where I wasn't dealing with as much of in industrial where these bigger things matter and there's heavier types of insurance and, there's higher risk of these businesses failing or, it's just a totally different model because there's not all the risk adverse, away from it. Whereas like a triple net lease, that one tenant leaves, it's a great opportunity. This one single retail, like a Taco Bell or something, right? Mm-hmm. It's great. It can cash flow you. You have to do nothing for it. But if that tenant leaves, what do? There's a Taco Bell and it looks like a Taco Bell.
Yeah. Yeah, we've seen some of those.
And then it becomes like some other Mexican restaurant, and
yeah, you can
or
see
a
the
nail
shadow
salon. I
of
don't
what
know.
was there before. With you mentioned about some of the cash flow you can get on some of these multifamilies, right? And I think it's the same thing. Like, can I find a motivated seller? Right? Always, if every deal, regardless of anything that you do, every investing opportunity begins with a motivated seller. Somehow, if the seller isn't motivated, it's not going to be an opportunity. And where can I add value? So on the multi side, let's talk some of the numbers, like cap rates or ROI. Like, how are you calculating that? Because on the residential side, lots of stuff gets thrown around. We've talked about the 1% rule. Sometimes it's just what kind of sort of baseline cash flow. I need a minimum amount of cash flow to own a single family residence after I pay my bills. On the multi, are you evaluating with cap rate? Are you evaluating with just absolute cash flow? How do you underwrite these?
So let me work you in, right?
Yes.
If you're one of the people in the room who want to get into commercial, you can start with the 1% rule. It's kind of like should I dive further in? It's not going to be your bread and butter. Yep. Then you're going to go into cap rate. Cap rate, people get really hung up on cap rate, but the cap rate's really should I dive deeper into this model, right? There's no exact science, and an 8% cap rate can be plus or minus $400,000 on different deals, right? So it really doesn't matter. It just tells you I'm going to dive in further. If a property is listed at a 4% cap rate in Cleveland, I'm expecting closer to an 8. I'm probably going to not be able to get close to this person's number, so I'm not even going to dive in deeper, right? If I'm listing it around a 7%, people start to play with that. We can kind of negotiate those terms a little bit. So cap rate will get you in. It's just that warm or cold, filter. Is should I do more?
What is a good definition of cap rate?
You want to put me on the spot like that. So the cap rate is basically there's an inverse relationship between what the NOI is, the net operating income. So that's your expenses, your income minus your expenses creates your NOI. And then it's that number coupled and compared with either the cap rate that you want to see, which can be 8%, 7%, and that gives you what the purchase price you could buy is. Or you take that NOI, you divide it by that purchase price, it'll give you the cap rate it's being listed at. I don't know the Knoxville market. Yeah, right there. Yep. But what's cool is it all inverts, right? So if you're trying to find the cap rate, you do this model. If you're trying to find, the property value, you're just going to invert those numbers. But it's just a temperature gauge. And then when you go further into it, it takes time. You're just really underwriting every part of that deal to come up with what you feel your numbers are. I like to create my day one, which is what I expect my expenses to be with the current rents and where they are. That gives me my day one. And then I also create like a year one pro forma. And that's once I stabilize the rents and get them where I want to be. What does that look like? Okay. And then my gauge, is this a good deal or a bad deal? And again, I don't know exactly for Knoxville, but I would say this is a pretty fair number, is I'm looking for a minimum $150 per unit per month cash flow after debt service. That's this deal worth?
What's debt service?
Debt service is your loan.
Yep.
So if I'm looking at this and I come up with my property and I have my purchase price and I know what my yearly NOI is going to be, right? So let's say it's $100,000, and I don't have a calculator, so if I throw out numbers, I'm not going to be able to answer this question. But let's just say your NOI is $100,000. And then I have to take out of that what my loan will be. So then I run it at, 6.5% for a 10-year term with a 25-year amortization, and what does that number look like? I take that number out of it. It'll give me my cash flow after debt service. That's the number that you truly expect. And if you're underwriting right, you're being conservative. So hopefully this number will be higher. But if it falls too far below $150 per unit per month, it's probably just too low to make sense for me. And people are like, God, that's not a lot. Well, as you get more units, that's why they do more units. What we haven't touched on that I think is important to note: why do you go into commercial? There's a bigger headache and I'm doing more time and it takes more time to close and I've got to refi every year. Well, when you go to do that refi, you're taking that capital gains and you're going to roll it with the 1031 into a bigger property. And so $150 per unit per month on your 6 unit isn't anything. But in a few years, when you cash that out and you refi into something bigger, now you've got 20 units at that. And then you do it again. And now you're just rolling your taxes and your capital gains up. And then what he talked about was that cost segregation. Then you do that. And now you're taking more depreciation, which is putting more money in your pocket each year so that you're not paying it in taxes. And you take that money and you reinvest it in more property at a better interest rate or a better cap rate.
Can we talk about management? So at what point, because we talked about 30 to 90 units, like we're getting into, I don't know if is anyone property managing here? Dan's not here today. He's as a church function, right? Like at what point I need on-site management? At what point does it become too much to manage on my own? What are your thoughts on that? Like, what are the differences? What's kind of the break even versus like managing a fourplex can be straightforward. When I have a 19 unit, maybe I need on-site laundry, or like what does that start to?
Yeah,
what's the number?
I would try to get on-site laundry basically for any property, especially if you own the washer and dryers, because that's just additional income you'll create. But when it comes to on-site management, if the building has a management office already built into it, there was a reason for it at some point, right? And normally they're this little hole in a basement and they're kind of weird, but that's a clue. But really that's up to you as the operator. If you only own that 30 unit, you probably don't need on-site management. But if you own 16 30 units, I'd probably get on-site management. And why on-site management versus just your general property manager is because that person is responsible for the overall well-being of this property. They maintain the tenant dynamic. They maintain the demographic in that building. They understand the rents and the models. They become part of that business. It becomes its own business, right? And so you want that person there because they strengthen that sales pitch. And you can have somebody manage a couple of those, but you can also have offsite management. A lot of people, a lot of out-of-state investors, they own many, many multifamilies and they do all the management themselves. You just have to have a good software and probably an admin or someone handling that for you. Personally, it's your wherewithal. If it's one building, one roof, one boiler system that you have to manage and just a bunch of tenants, I think that's probably easier than having 30 single family houses to manage. So it's really just where your comfort zone is.
Yeah, just a different schedule, different mindset, different approach to the asset that you're managing. There's a slide here that talked about this, of just what the opportunity is with motivated sellers. Vendors, like, do I have the right vendors? Do I have the right property management vendors? Do I have the right maintenance team? Can make or break that, and maintenance schedule, and then just tenant communication. Like, how am I communicating this information with the tenants?
Let me put this out there. We are all becoming investors because we want passive income, right? There's never passive income. It's always active income. And what do I mean by that? I'm going to hire a property manager and I want them to deal with the day-to-day. So I can step out and I can do my business and find more properties, right? But I had a property where very, very strong investor, he's actually very high up in KW. It was all going to work for itself, right? Well, we went back in, this management company was charging him, like, the late fees came in as income and went to his name, not even his property management company, as an expense. And it just said right on there, late fee expense. And I'm like, what? And so he was very experienced. He knew what to do. He knew what to look for, but he wasn't looking at it anymore. So when you hire a management company, whether it's for your residential or it's for your commercial, you should be reviewing those numbers every month. Are weird things popping up? Because property managers love to try and find different places to charge you a fee. Eventually, those people were like, we're actually going to start charging you to pay the bills. You already are. I'm paying you 10% every month to pay the bills. And they wanted to add these fees, and they will keep doing that, especially if they recognize that you aren't paying attention to it. So whether you like to be active or you like to be a helicopter parent, I would do it. I would look at your financials and make sure you're paying attention to it at least quarterly.
Anybody have some other questions? We can talk about CAM. We could talk about triple net, different kinds of leases. We can get real deep on underwriting some of these.
Someone ask a question. Come on.
This is a very quiet.
It's a safe
This is the
space.
Quietest room.
It's a safe space.
I'm gonna
start calling some folks out
because I'm curious.
I don't want to answer your question.
That's fine. I've been looking at liquidating some of my single families and pivoting towards a multifamily investment, right? And what I find I'm running into a lot here in Knoxville, and I would imagine you see it in Cleveland Wells, a lot of mom and pop landlords with a lot of just shitty books. They just have no records. They have nothing to go on. At best, you might get like a lease in there, like let alone deposit slips and when certain improvements got made, etc. What can I be doing in those situations? Like, I mean, I guess, do I just have to make crazy low offers to offset, like, how do I do my due diligence if I'm not really given much information on the front end, say by a listing agent?
Really great question. So a couple of things. The first thing is another difference is that your inspection period, your due diligence is typically at least 30 days in commercial. On that type of deal, you're going to extend it. Ask for 60 days minimum, right? Because what you're doing is you're basically creating their books for them. Okay. So you come in and you're going to do it. Again, I love Intel CRE. If anyone's interested, I have a code that I can give you to get you a discount. But Intel CRE is a platform that just makes it so easy for everybody, but it also works for high level. You can import the rent roll or you can type it in manually. You can import the expenses or you type it in manually. It automatically creates a pro forma or you can manually audit all of that. You can import your sales comps and your rent comps, and then it creates all the financial analysis. You input it and it creates it all for you. So it tells you your cap rates. You do this because you have to verify everything. In that case, if there's no leases, you're going to get those estoppels. It's going to have to be part of the due diligence. You're going to run all of that. So how are you going to do that? You're going to call the water company. The water company will typically on the phone give you month by month what the water bill was. The electric and gas companies aren't typically that friendly, but you can work with the owner and say, look, we're going to get in the portal, we're going to get this, and you can get the printouts. So then you're taking all of that and you're creating that T12 for them, but for you. And a lot of times, if you're coming to that owner and they're ready to sell and they've got to get out of this and it's a mom and pop thing, other people don't want to spend that time.
Sure.
So you can get a better deal because you're going to do all that. And then you're going to say, look, because you don't have good books, this is where my offer is, but you already know what the books are. That's not really the excuse. The excuse is that you had to do that time and you're getting paid for your time.
Or I found it like a couple recently, like literally in the last couple of days, some of these conversations have been, if I've requested, hey, like, can you shoot me over anything like a trailing 12, just like something to go on? And it's just, they either don't have it or they won't until they have like an acceptable purchase contract in place. And so it's just making it hard to be like, okay, well, do I just go tie this up to then go spend the time, money, like after energy, and only like lowball them later? It just felt like just such like an extra runaround when.
Are these residential agents perhaps listing this commercial property?
Yeah, actually.
Oh, shock.
Yeah. So what you do in that case is it's totally dependent on them, right? So I would tell them as a Mr. Seller or Miss Agent or whatever is, okay, you're saying they're all rented around $900. So we'll use $900 a month. And what, you think the expenses are probably on normal, about 50%? Like, yeah. Okay, so the NOI is this, so I can offer you this. And that's strictly based on that. If you want a better price, I'm going to need the financials. Otherwise, this is what the fair market price is. But we're going to have to dive into this. And I can't promise you that that price is going to stay the same after we close, but you're just being transparent. For residential agents, a lot of time it's teaching them how to do this. But for the mom and pop owner, this is just how it is. This is the cap rate in the area. So this is how I come up with the price. I'm not being unfair. I'm not being anything, but this is what I know. And then if there's a lot of work that needs to be done, you kind of got to factor it out of that price as well.
Sure.
Well, it's one thing to think about it. Like we talked about sales comparable approach, like comparable sales is how we figure out residential values, right? In this case, we are creating the value. We are literally creating the value. That's a great seller. That's almost like an owner financing. Hey, if you work with me, I can get you more than anyone can, but like otherwise this is impossible because here's what Jeremy's going to need to finance this. Like I cannot purchase this at this. He will not approve it. So if you do not work with me, no one can buy it for you at, 400. It's mathematically impossible for anyone to purchase this from you unless you work with me to get some of this information.
So what's fun is that Intel CRE tool, I use it all the time. Again, I told you I underwrite for the buyer. I take it to my seller and say, look, at these numbers, your DSCR is 0.9. Nobody can buy this. And they can't argue that. Nobody can buy this. So we've got a few options. We either have to place these units, we've got to take a few months and get rid of these expenses, or we have to lower the price point. And they can't argue with it. It's the facts as it is. 1.25. That's what they need to be at.
So this goes back to a Cory special, actually, what Cory is really good at doing. And if you on the residential offer is creating an offer, right? This is what we got from Mike Zenicola. one of your guys. So Mike Z is just like writing this offer and writing an offer that is so good that whoever I'm presenting it to, whether I'm talking directly to the owner or I'm presenting this to an agent, it's like I'm sitting in the living room explaining this. Here's why we made this offer. You've got a great home. You've got these assets. Let me walk through all of the math and like why we can offer this, why we think this is a good deal and you should work with us.
Even if you don't have a lot of the information, based on what you're telling me, and I'm just going to take your word for it, right? That's what you're telling them. Based on what you're telling me, these are the numbers. And do you agree that there's an 8% cap rate here? Okay, cool. Okay, so you do it. And you said the roof needs fixed. All right, so that puts us, this is the number. Mm-hmm. And at that, and then you could do the DSCR, you could run Intel CRE. That's just the conversation. They can't argue with it. But I'll say this, how easy is it here to get creative financing on residential deals? Does anyone run into that a lot?
Yeah.
Here and there.
Okay. It's easier on commercial.
Very.
It's much easier on commercial. And if you're trying to buy a business, it's all day.
Ooh, okay, so can we talk about this? Can we talk about inaccurate books on businesses?
Ugh. Okay.
Right?
Don't buy a laundromat.
just we'll go to that, but just the same opportunity exists. So if you know anyone that owns a business or you're looking for someone for a business, if they've been underreporting their cash income so they don't have to pay taxes, fantastic. But then, right, what is value based on? Income, right? They've submarined the value of their business.
Hey, so investors in the room, you do the same thing to yourself. If you keep underdoing your value so that you can pay less in taxes and you go to try to get a loan on a commercial building.
You're just submarining your borrowing power.
You just decreased your own value there.
Yeah.
But
if you, I love it. Jeremy said, if you want to grow, you got to show. So we got a question in the back, RJ. Yeah. And then we'll go, RJ, bring you the mic.
Yeah, it's like a decent segue. I feel like a big turning point for me opening my eyes to commercial was learning about triple net. And we haven't talked about that at all. I know it's been like stepping stones from to multifamily.
Yeah.
But I feel like that's the true, like if you're looking for more hands off, but at the same time has greater risk. So
do you have a triple net lease on your coffee shop?
We did when we triple net to ourselves.
Yeah, because they bought it.
Oh yeah. Fascinating. So you're doing triple net and then okay.
Yeah, so awesome. We bought our commercial space and now we lease back.
Because that's like a commercial condo, right?
Yeah.
All right. Who knows what a triple net lease is?
I don't.
Okay, who doesn't? So we should probably dive into this. Okay, so there's a couple different leases, and I'm going to be honest with you. Don't trust whatever someone says. It depends on what they're talking about. Because half the time, even commercial agents don't know what they're talking about. But so a gross lease means I'm charging you $800 a month to lease this space. I'm paying the utilities. Your amount covers your rent and your utilities. There's nothing extra. A modified gross means you're paying me $800 a month, but you also pay electric and gas, right? So there's something that's modified about that. And then you can move into your triple net lease, which means I'm charging you back a triple net fee. And if you're in like a shopping center, the way that will typically look is it's like one number. So I'm doing one right now. This is extraordinarily high, but it's $11.46 per square foot per month for the triple nets, because that's going towards the taxes, the insurance. It's going towards the maintenance of the building, which are your big three, but then they're also charging for parking. They're also charging for marketing and these outrageous things. But basically what the owner is doing is effectively not having any expenses. You're responsible for everything. There's an absolute triple net where you're literally, if the building burns down, I was telling someone about a dispensary by us that's available. And if the building burns down, they're responsible for all of it. The owner just collects the cash flow every month. You do nothing. You just keep your bank account open. The money gets deposited. There's nothing else you have to do for this building unless it goes vacant. So then you care about those long leases. So the triple nets are really cool because of that. What that looks like in residential, guys, is RUBS, right? You're charging the tenant back their utilities so that you don't have to pay the utilities. So it's something that you'll see across the board. Triple net leases are really cool. You're going to see them like a Taco Bell or something. You know, it's not McDonald's, but a Taco Bell or one of those would have a triple net lease. They're responsible for everything. A lot of shopping centers will. I think I see more modified gross than anything else. But triple net's the way everyone wants to go, so that things are already built in.
All right, Robert's got a question and they'll come to you, Duke.
Very simple. Curious for a beginning investor going into the commercial space, aside from multifamily, what would you recommend?
I
In
love
terms of asset classes?
Asset base?
What would you recommend in terms of asset classes or in terms?
Exactly.
Yeah. Okay.
I love mixed use. I think it's great because you're diversifying yourself, right? You've got retail, so you've got long tenant terms, you've got less maintenance, you got less management that you have to do, but then you also have the residential, which is consistent, the year-over-year growth that can happen for there. So you're kind of strengthening two different sides, right? There's a weakness, strengths of one and weaknesses of another, but you're kind of countering yourself in that one asset class. So in Cleveland, I love that. And it's something people don't even look at. They're always searching multifamily or retail. They are not searching mixed use. And LoopNet doesn't even have a search button for it. So they file it under retail, but people who want true retail, triple nets, they don't want mixed use, right? And so it's just like this hidden gem where you can get really good deals because people don't know how to value it.
In mixed use, you can get creative too. You could have short-term rentals in there as well. I've seen that, like long-term rentals, monthly, like a truly mixed use.
You can get an owner occupant who wants to live in the residential unit above and rent the storefront below.
Yeah.
So it depends on what you're trying to do, right? The zoning is typically going to be something like retail, and so almost anything can go in. But if you want a bar to go in, that's going to be higher, right? I would keep it small, like a 2 retail that's you're typically going to use as like a boutique or something like that. When you get into like salons and we're digging out the floor, they're expecting the landlord to do that repair and you're probably not wanting to do that. So it'd go into a market where the expectations aren't a bar restaurant and you're dealing with a whole different, caseload. But I think mixed use is a really great opportunity to do it.
I'll give you an example. Someone I know owns the Subway building. And then above the Subway building is like an Airbnb. Like, fairly easy to wrap our head around what that would look like, right? Long lease with Subway and then, or condo, whatever. Like renting it out it wouldn't be that difficult for you because you already can wrap your head around it. Mixed use can also be easy because just like the best short-term rental owners are people that like hosting, right? If you have a mind for retail, like if you can wrap your head around it, it is fairly straightforward and what you think might work there.
And if you're in an area where the retail isn't working, it's a zoning thing, but I've had many, many properties where they turned the lower units into residential units. You add a shower.
Yeah, fascinating. Duke.
Okay, a few minutes ago, you said words to the effect of it's easier to get investors for
creative financing.
Creative financing
for commercial properties.
Yeah, for commercial property than residential. And I can see probably what you mean by that, but I want to just ask you directly because I'm sure you'll come up with something in addition to what I was thinking about.
Yeah, well, the first thing is that as an owner, when you sell this building and it's commercial, the price points are typically higher. So the amount of profit you're going to make is going to be higher. So wouldn't it be cool if I could offset some of that for you over the next few years? So you're not going to get that big capital gains tax hit this year. We're going to offset it. I'll make payments to you. You're only going to make that profit for each of these months split across 5, right? So then they're like, okay, wait, because they're just about to profit $500,000. They are retiring. They don't want to move it into something else. That's a huge hit. So it's pretty cool if I can offer you a solution to do that, right? So then the next piece of that is if you're trying to make the deal work and they need a certain number, if they can make a little bit of extra money on it, that's how you make that number that they're looking. Okay, Mr. Seller, I will give you, $1 million for this property, but I need you to seller finance 15% for me at 6% for about 5 years until I can refi out of that. Why would I do that? Well, A, I'm going to defer those capital gains for you. And B, you're going to make more money on the interest for those next few years as we go. But what did that just do for me? My down payment just got reduced by 15%. So I'm coming, and then if I throw my commission into this, I just bought that building for nothing.
And you might be able to get a lower rate than you would get on the street, where you might get charged, like we're going to quoting 9%.
Another good point to that is if I'm doing that, right, that $1 million building just got reduced by 15%, the price point. So now my loan is actually much less than that because I'm actually not coming out of pocket with that same amount that the 30% was before.
I actually have a question for Jeremy. If RJ, you want to can you talk to us just a little bit about what you're looking for on the commercial financing side? Some differences. You've been in banking a very long time. What time I've known you?
So one of the things that I'd like to touch on is with the commercial is that we're continuously looking at that. When you do a residential, we do the loan, you go on, and you got your term, this and that. Commercial, annually, I'm asking for financials. So I need to see if you're still cash flowing the same. Right now, I inherited a book of business where some people were like 0.8 debt service coverage. She was spot on. We're looking for 1.25. So every dollar that you make or got out, we want you to make $1.25 off your dollar at minimum. So we're continuously looking at that. And a lot of people think, oh, I got the loan, so I'm good. And they don't realize that I have to do an annual review on you. So if you're hiding your money because you don't want to pay taxes, now it looks like you went from a 1.3 down to a 0.8. Now you went from a 4 rated loan, which is the lower the number, the better the rating, to 8 to 10. Now you like special assets. So I've had clients that literally shot themselves in the foot because they were just trying to dodge taxes, and then it becomes problematic.
If you're new here, we're throwing around this term, and debt service is the same as debt service coverage ratio. We talk about short-term rental. Ratio. It just is, hey, if my rent is $1,000, I am making $1,250 in income, right? Then I got to gross more. So I'm got same thing, just like when we're doing like a short-term rental. But you're looking at debt service because you guys can call a loan, couldn't you?
Yeah, and so there's a couple that I'm
you can make the loan come due early,
or make you pay down. So I've got one guy, and I'm like, hey, you got to bring me $250,000 in order for me to keep this loan on the books. And that's not what I don't want to do that. So it's like you talk to me, communicate, and if you have a relationship with your banker, I'm gonna tell you where you're at. Like, hey, basically, you're here. You need to show this much income for the most part for me to be able to make this stay off the bad side list. And
here's a little nugget for you: is that information? If you have CoStar, it's there, so I can search by people who are on the watch list. The people on the watch list are the people who the lender has said you're not performing. We're now watching this property. You have to submit documents, whatever. So I can look for the owners who are on the watch list, and I can reach out and say, hey, you want to sell this property? And go buy that thing.
In investing, one of the things we took from Bob Kalinske, Bob, I've talked about him before, had bought the Southeast region of Keller Williams. And at one point when I was there, we were the 6th biggest real estate company in the U.S. Came and talked to us about how they grew it, what he did, the lessons that he learned, because he had busted out twice in his career and bought that at 55. And he said, you have to have a board of advisors. And one of the board of advisors is a private banker that will pick up the phone for you on a Saturday on the golf course. Like, thank you for coming. I wanted Jeremy to come here. Like, I have some long-standing relationships with built relationships with local banks for that reason, because it is an ongoing conversation. So if you're a business owner in the room, right, start building that relationship, right? Look at the revenue you're doing, your personal banking. Like, what could I do to build that relationship with them? Because that's going to take me much farther like you said, if I want to grow, I have to show. Working with someone along the way, they have more latitude. They understand your business better. They have access to capital, where your cash machine, right? Sometimes that same person can also be lending you for your wealth machine as we're doing some of those projects.
You need the lender on your side. You need a realtor, because call them. Hey, what are market rents? Where should I be at? Because that's your value of your property is built on those rents. Where are these at? And they probably also have the resources to try and maybe get some of those other expenses lower. Do you have a better landscaper? Do you have a better garbage company that's not going to charge me so much? A better maintenance guy, right? Yep. So they'll have those resources for you. And the last one that people don't think about is your CPA. Because when we're talking about commercial, you heard it. When we're talking about commercial, the name of the game is trying to defer as much of these taxes as we can. And that's what makes commercial so powerful, is I can get into it. If I can get the seller to seller finance me, let's say 25%, and I was able to get a loan for 25%. I came into that deal with $0. And then I create the equity, I raise the rents, I do the things, I go to refinance that loan. I can pull money out of that deal now, roll the rest of it into another loan as my down payment for that loan. So let's say my profit was going to be $100,000. I have $100,000 down on a new property now. So then I get a bigger property. I create that and I just keep rolling it. And then if we can find the other tax deductions from the cost segregation, which cost segregation, they're coming in and they're giving a value to everything in the property, the fixtures, the flooring, they're giving a value to everything. And they're allowing you to take accelerated depreciation on all of those things. And it took me a while. It's like, why does this make sense? Well, if you're paying that amount in taxes now, all that capital that you could have had in your pocket is being spent in taxes now. But you can take that capital that you're saving, let's say it's $15,000, you said, right? That $15,000 is a down payment on another property. And that property can make me way more than that those taxes were going to, right? And so having that CPA who can find those little things, tell you to go buy a bigger car, can kind of do all these different things for you. That's the name of the game.
This is why you see people buying 7-figure short-term rentals. Right. And they're running that play for a while, pulling these back
I have a client who's literally looking for a multifamily property right now just because he wants the tax deductions.
Yeah.
That's the only reason.
And the other thing to think about, what's unique about this is, one, I can leverage this. I can borrow this other money. Two, Jeremy, is it okay if I have a seller second on a deal if I disclose it's okay with you guys?
It is.
Pretty normal, right?
Yeah, pretty normal.
Yes, that's what's interesting. To answer your question, Duke, thank you for asking. That's a great question of what's specific. It is very normal for a seller second or to get creative with these terms. Seller carry, you might hear that also mentioned in a commercial deal to make the deal work. And you're not creating taxable events, right? That's the single biggest interesting thing is when we go refinance, that's not a taxable event. Where else can you go, hey, I just got $100,000 in capital. I didn't have to pay any taxes on that. It's not being reported as income. Like that's the difference with creating debt. It's what all you look at Elon, you look at all those other people, they don't actually, right? They're borrowing against their stock portfolio. So everything is debt. That's how they're leveraging that, is they borrow against their stock portfolio, using like Goldman or somebody or Morgan Stanley. They're just doing it at a larger scale.
And you asked why 10 years earlier, right? Why the 10-year term? A lot of investors in commercial aren't waiting the 10 years. If you're in a stabilized asset, maybe you are. But a lot of times if you're coming in and you're doing like the burn method, they want to turn and burn that money. That money can be making them so much more money than it is in this. It's like a step ladder, right? Let me use this 5 unit to get my 10 unit, to get my 20 unit, to get my 50 unit.
Can you talk about forced depreciation? Can you just explain what that concept is? I want to put you on the spot, just what you just said, but you might hear this term come up in commercial where if I increase the rents.
I'm in Cleveland. We have no appreciation.
Okay. Fair enough. But what you were seeing before, people buying multifamilies, go to Class B or Class A, increasing the rents.
Yep. It's the BRRRR model, right? Yep. If you BRRRR, like BRRRR is my preferred method. My husband's my contractor. We started the property management company as a result. It makes sense, right? Let me buy it for cheap, add a little value, rent it out, refinance it, and call it a day. That's exactly what you're doing with commercial on a consistent basis. You're only buying a truly large, stabilized asset when you're a fund. There's really not a ton of, besides the security in it, it's safe. It's going to make you this much. Besides that, you're really coming in. We all want to make that profit, right? So I'm coming in with the value add. I want to create that value, force that appreciation. A good example is I have a property right now. It's 4 units. It's mixed use. Upstairs will rent for $1,450. Lower unit, you've got $800, $1,250, and $400. I'm asking $225,000 for it. Okay. In placing those units, and there's maybe $25,000 in work that's needed. In placing those units, only placing the units at an 8% cap rate with a 50% expense ratio, rough numbers here, but it's mixed use and we can offset all those expenses. So your expense ratio should probably be at least 40, right? But at a 50% expense ratio, the value of that building is $350,000 to $360,000. You're buying it at $225,000. You're putting $25,000 into it, $250,000. So you're creating $100,000 of equity by placing tenants and minor improvements. That's the power. I don't want to hold that thing for the next 10 years, right? It's only 4 units. Let me stabilize that. And lenders, a thing we should talk about is that lenders are probably going to look for about 6 months of stabilization. They might be looking for 12 months. So you can't just place tenants in, go to sell it and call it a day. It's not going to work that easy. But let that stabilize. Let it kind of, season up a little bit. And then we sell that. And I'm going to take that $100,000. I might pocket a few bucks. And then I'm going to put the rest of it in the down payment, the next one, have them seller finance it to me and make it a beautiful little process.
No, what we talk about, it's why the tax code is written this way, is like, if I'm placing 4 tenants and I'm stabilizing a unit, am I improving the local economy? Am I adding to the tax base? Like this is genuinely where I get excited. I get very excited about like working in the real estate space. I'm such an optimist, right? I don't know about you, Cory, right? And we're both like pretty kind of punk rock people, and we're so optimistic about capitalism because we work with small businesses, we work with entrepreneurs. Like this is
and let me help you guys get even more excited.
Adding real value to the community.
Get more excited about it, right? If maybe you have a passion, veterans, okay? If you were to buy a 6-unit apartment building, house it to all veterans. Create a space in there that they need. Create a service in there. Have, home health or someone come. You can do senior housing the same way. Not the senior housing where it's like assisted and you need an elevator or you need that size, right? But you can create that. I've heard of like special needs. These 30-year-olds, I grew up right next door from a woman who, she's special needs, but she's functioning. She can do this. They just have home health there and provide this extra service. The parents are the ones paying it. That's easy cash money, right? But you're just giving a space for these people to be. You can, in the different units, put something that you're passionate about, right? Mm-hmm. Maybe there's a charitable thing that you want to put in there. Give them that space at a discounted rent. That discounted rent is still tax deductible. And you just keep rolling it.
If you want to get really excited about this, I recommend you go to the YouTube channel, Grid Investor, and you go Tactical Tuesday and you watch the episode with Gretchen Kingma. Gretchen is building out one of the senior divisions for one of the national real estate brokerages. She is a occupational therapist, and she just walks through the opportunity, right, with our aging population, mobility issues, universal design, just really fascinating of like, there's a huge opportunity to be of service to people to retrofit properties. And the money there is also really attractive. Like the demand for these things is so high. It got me very excited. I love things like you said, where I know we're providing a genuine service to people and we're getting rewarded for providing that service. That's when all of this works correctly, right?
Yep.
When we're being rewarded not just for speculation, we're being rewarded for creating value.
There's a lot more creativity in commercial. Another good example, I'm personally looking for an office and I found a space. CVS owns the building. They were leasing the upstairs. They have a sublease on it, right? I'm basically about to Airbnb arbitrage this sublease. Okay. It's 1,290 square feet, but it's technically 3 totally separate offices. And I'm sitting here like they are offering it to be at $8 a square foot. In disclosure, my brokerage wants $27 a square foot and the average is about $16. So at $8 a square foot, it's because it needs rehab and CVS doesn't want to rehab it. So they're going to give it to me on a killer deal. And I have full allowance to be able to rent this to other people. So I'm going to make money on these leases. My lease will be free. And then I'm going to use the window space and I'm going to get my sponsors to pay me for my lease to put their signage in the window because it's a busy intersection. So there's so much creativity you can do. Now my office is going to be free. I'm giving other people a space to live. The one unit I'm going to use is like a co-working space so that instead of other people who their brokerage wants to charge them $27 a square foot, they can come to me and I'll charge them $12, which is still below, but I'm still making money and living free.
Anybody get some value out of today? Yes, fantastic. Erin created something for us. We're going to send it out to everybody. She put it on her website though as well, ErinThomasTeam.com. So it is tell us about what this is.
Yeah. So we were talking about it and I haven't done this before. I've been asked for it a lot of times. So you guys are the first people to get it. I created a very in-depth due diligence. This is me over time just adding things that I'm like, oh crap, I need to put that in here, right? So it is, I think it's 2 to 3 pages of things that you should do in due diligence. The first section of it, I actually have on the back of my LOIs that I send with everything. These are the documents that I'm requesting. If you can't provide any of it, cross it out now. So I'm aware of it right now that you aren't going to be providing these documents. And I'm going to create a link so that you guys can all have it right there. And then you guys will have everything you need to do any kind of due diligence, quite frankly, on any property, but it'll cover it for every asset class of commercial.
Yep. And Sweet. If you go to the website, if you're curious about, thank you so much. Yeah, that's super cool. If you're curious about coaching, Erin's a coach as well. Didn't want to oversell her, but yeah, there's a reason why I rely on Erin because she just does this and is in this more than anyone that I know, like actively doing it, leading from the front. Thank you so much for coming out today.
No, happy to do it.
Thanks for coming out.
Thank you for being here. Vernon, when is Grid Smokies this month, sir? Put you on the spot. We've got something really cool for Grid Smokies. We've got Lauren Hammond coming. Who in here markets for their cash machine? Who in here is actively marketing to the public to get business? Okay.
We should probably talk about coaching.
Yeah.
Based on the number of hands that went up.
I saw some agents that don't market at all. It's fascinating. So we've got Lauren Hammond coming, right? Talking about the 4 C's, going into incredible detail about how she's created $600,000 in revenue off of Instagram. Like, she led our Kaza team, our $1 million sales team. She's in her early 20s. She is the vice chair for ESPN professionals nationally. Very impressive. She was here for a regional rally. When is that, Vern?
That is August the 25th. We're at the Pines, downtown Sevierville.
Yes. And if you're talking about mixed use development, talking about this, Compass Development, one of our sponsors there, is redeveloping, revitalizing downtown Sevierville. They're building subdivisions. They've got McCarter Hollow going in right across from Dollywood. Again, like, come down there and expand your vision for what's possible. So thanks, Vernon. We got that going on. Cory, we all heard a lot from you today, but you have any last words for us?
Yeah, no, just thanks everybody for coming out. And then we'll be here next month. That'll be September 5th, talking about new construction.
Ooh, that one's going to be great. We got a couple local builders that we use. We're going to go through exactly the fundamentals. We happen to think right now in our market, based on the things that are happening, the value of land, that like building new, building to rent, building multifamily mix is one of the best opportunities in the market.
Yeah, absolutely.
That's the plays we're running personally.
Can I throw something out real fast?
Please.
Is we only touched on it a little bit, is grid coaching honestly is incredible. I'm personally in coaching. I've always been in coaching. I think to get to the next level, you need to have a coach, right? Somebody to hold you accountable and who helps you see the things that you aren't seeing yourself. And grid coaching allows you to do that. They've got an agent path, they've got an investor path, an investor agent path, commercial. It honestly doesn't even matter what your business is. You could be in a mechanic trying to grow their business, and the coaching would work. The same frameworks would work. And you guys do a really great job that I don't think a lot of other grid chapters do in really teaching you guys about the cash machine. Like, I've heard you say that multiple times, and you guys
we talk about the 7 levels a lot, right?
The 7 levels of freedom. This coaching is totally unlike anything I've ever been a part of, because it actually is giving you documents and resources and worksheets that are building you through the 7 levels. And when something pops up, you're like, I don't know if I can do it. Whoop, we're going to go right back down to the first level. We're going to work through what that issue is, and we're going to keep going. So if you're interested in coaching, I don't care if you're just kind of scratching the surface, you're not sure if it makes sense. I might not be your coach, but on that same website you guys are going to get, there's a coaching page. We can schedule a call. We can do a mini boss audit, which kind of just has a quick in-depth analysis of where your business is and maybe a worksheet that might help. And then you can connect you with Maria, who runs Grid Coaching. It's a really, really great asset, a great resource that if I was just starting out or just kind of stuck somewhere, I would tap into this.
And on the commercial side, you need something like that in your world. What she's mentioned, what I've mentioned, like, so Kayla, tell me if it's the same. When I'm working with a commercial buyer, half of it is coaching them about whatever they're trying to do. Like, hey, does this make sense? Have you really looked at your P&L? Like, running down all these other aspects, not just selling a building. It's easy to sell a building to somebody. It is like, if I sell you this building, are you actually going to be operational next month? Or did I do you a disservice by getting you this building because you don't have
Can you afford it? Is it enough square footage that
you're going to burn up all your cash flow before you get it, before you actually bring it to market? You're not going to get permitting. We sold a building and how they put a lease in there for a school. They started the school, they didn't have the permitting. They shut it down. It was this cool, like, hippie daycare thing. I loved it, but they crashed and burned, wasted all of that money.
I had clients who bought land
just
to
happened.
do a building, and the city wouldn't approve the building, and they never went through that as their due diligence.
That building
process
I had sold on Hollywood. If anyone saw that one, the giant sign, that's what happened to the buyer there. Yeah, the buyer had it, but who they leased it to. So, anyways, thank you so much for coming out. Hang around and network with us. We will see you all next month. Appreciate you guys.